Now we know that assets equals liabilities plus owner's equity, right? That's review. Let's talk about assets. Assets are those resources that you own. The ones that are on the screen, I think we have talked about all of those except for maybe prepaid accounts. Prepaid accounts are assets. They are things like, well, let's say it's the beginning of February and you pay your building rent for February, March, April, and May. So you've actually prepaid 4 months worth of rent. Well, that is an asset. That would be called prepaid rent. Okay? Make sense? Or here's something else that you prepay for is insurance. You know, let's say you lay out $1,200 for the next 6 months of insurance. Well, that's not just for this month, it's for future months as well. That's a prepaid asset, specifically prepaid insurance, and that's an asset. You with me? But going back to the computer, we've talked about all those assets before. Now we have talked about these liabilities before. I don't think we, and there's unearned revenue, right? Unearned revenue is a liability, not a revenue, but a liability. I don't think we've talked about the term accrued liabilities, though. We'll talk a lot more about this in Chapter 3, but those are things like salaries payable, or wages payable, or taxes payable, or interest payable, okay? So that's actually kind of the title of a subset of liabilities. But we'll talk about those more in Chapter 3. Okay, and we talked about equity accounts and what makes equity go up, what makes equity go down. Remember that? All right. And again, there is the accounting equation, and we talked about how you could expand that based on what makes equity increase and what makes equity decrease. Correct? Now let's talk start talking about the accounting cycle. Now this slide's not going to mean a lot right now, but we're going to come back to this slide at the end of the chapter and it's going to make a lot more sense. What we're going to find is what we are going to analyze in business. We're going to analyze transactions and events from source documents. Now what is a source document? A source document are the items that are generated by us conducting business or transacting. For example, you have source documents in your own life. If you go get an ATM withdrawal, it will give you a receipt, right? Or if you get paid from your employer, you get a paycheck stub, right? Or if you go buy a computer at Best Buy, they will give you an invoice, right? Correct? Even if you buy something online, they usually send you an email of your invoice, right? Now, in the old days, when we look at these source documents, we might say that these are pieces of paper generated, but now they're not always paper, are they? A lot of times they're email or whatever. If you go get a loan, you're going to have a lot of loan documents, right? But these are the sort of things that are evidence that a transaction occurred. And we analyze those source documents, and we are going to record those in what we call a journal or a general journal. And eventually we're going to post those to what we call the ledger or the general ledger. And then we're going to talk about preparing and analyzing what we call a trial balance. Now, this doesn't all make much sense now, but by the end of the chapter, it will make sense. Okay? All right. Then we have talked about things like, what is an account? What is an account? Well, an account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense item, right? And we have done this, okay? Going over to the doc cam, we had the account of, for example, cash, correct? And remember how we showed increases and decreases? Like we might say, well, it increases by 3,000, and then it increases by 500, and then it decreases by 300, and then it increases by 250, right? And then maybe, I don't know, it decreases by 200. I'm just making stuff up, right? Isn't that what it's saying as far as this is an item that shows increases and decreases? Right? And at any point, we can figure out what the balance of the account is, correct? What is the balance of that? Anybody? 3250? Yeah, it is. Good. 3250. That's the account balance. Is that correct? All right. So going back to this slide, an account is a record of those increases and decreases, and a general ledger is a record containing all of the accounts used by a company. Now, where we are at in your learning, remember when we did exercise 111? This is kind of like, for your purposes now, kind of like a general ledger, because it had a lot of different accounts, and it showed their increases and decreases, right? And it showed you the ending balances at the bottom. So that exercise 111 solution was kind of like this general ledger that they're talking about, a record containing all of the accounts used by the company. Okay? All right. Coming off the computer onto me again. Those of you who have had accounting before, you know that the way that we were keeping track of increases and decreases in account is not the ultimate way we're going to do things, right? We talked about this the other day. I think I mentioned the training wheels analogy, right? The way that I was teaching you how to do it with the plus 3,000, plus 500, minus whatever, that's kind of like the training wheels method. Now, did anybody learn how to ride a bike with training wheels? Okay? No? You guys were deprived, okay? Okay, thank you, Derek. Everybody's afraid to raise their hand. Training wheels are a way for a kid to get a feeling of what does it feel like to ride a bike? How do you learn your balance? How do you learn to turn? You know, pedaling, all that sort of things. It gives you the feel of what it's going to be, but it's not the ultimate goal, is it? So you learn how to ride a bike with training wheels, and then ultimately what happens? Mom or dad comes out with a crescent wrench, takes the training wheels off, right? Now, if you never learned how to ride a bike with training wheels, or you were doing very poorly with training wheels, how are you going to do when the training wheels come off? Probably not real good. You're probably going to fall down, right? But once you learn how to ride with training wheels, then you shift, the training wheels come off, and you learn the new method. And once you learn how to ride a bike without training wheels, do you ever go back? On a Sunday afternoon, do you ever think, you know, just for old time's sake, I'm going to put those training... No, you never do, right? You move beyond it, and you never return. Is that correct? Well, that's how we are going to be in this class. We are going to learn a new way of recording business transactions, and we're going to transform from the old Chapter 1 way to the new Chapter 2 and beyond way, okay? We'll never go back, all right? We'll never go back. So, let's do this. Let's kind of transition. Let's go to the doc cam. Now, this was the Chapter 1 way, is that correct? Now, allow me, if you would, to write this a slightly different way, okay? Okay? Allow me to write this a slightly different way, okay? Instead of putting it all in one column, can I put the increases on this left side and the, let me get done with that, and then the decreases on the other side? Would you allow me to do that? Okay? And, matter of fact, I'll draw a line between these to separate them. Now, what's the balance of this account? It's still $32.50, is it not? You with me? Okay, so you understand the transition from this to this? Yeah? Okay, well then let me make one more transition. Let me make one more transition. If I know that my increases are going to be kept track of for cash on the left side, and the decreases on the right side, let me do this. Let me get rid of those pluses and the minuses, and let me just put the numbers. Okay? If I know that the increases are on this left side and the decreases are on the right side, let me just get rid of those pluses and minus signs, right? So we transition from here to here, and now from here to here. And the balance is still 3250, right? Well, for those of you who have had accounting, you know what I have just done is create a T account, right? A T account. And we call it a T account because it kind of looks like a T, right? Well, the left side of a T account is called the debit side, D-E-B-I-T. The right side of a T account is called the credit side. So the left side of a T account is called the debit side. The right side of a T account is called the credit side. Did I say that right? The left side is the debit side. The right side is the credit side. Okay? Cool? Now, let's take a time out here. And let me tell you how your brain works. Yeah.
So that you're debiting, but did you say the increase on the left?
No. Maybe, let me say that again in case I said it wrong. For this cash, the increases are on this left side. This is the increases are on the left side. The decreases are on the right side. Okay? Hang with me for a second, okay? The increases I have put on the left side of the T account. The decreases I have put on the right side. Okay? You with me? And then I said the left side of a T account is called the debit side, the right side is called the credit side. Cool? Hang with me. I know your brains are kind of swimming now. Now, let me explain how your brains work a little bit. I've just introduced some new terms, debit and credit. Now, the way your brain works, come off the camera for a second. When you learn something new, your brain goes out there in your brain stuff and tries to find something you understand and make a link there. Make sense? Like, for example, if you know how to play baseball, but you don't know how to play golf, and you're having trouble being relaxed when you swing your golf club, your coach might say, hey, just think of the golf club like it's a baseball bat and just swing it nice and easy, right? Well, what he or she is saying is you understand baseball, apply that knowledge to golf, correct? Your brain does this all the time. If you learn a new word, you might break the word down and try to look at the root parts of the word, right? Well, back to the screen. I've introduced debit and credit to you, but you've heard those words before, have you not? I want to caution you. Listen to me closely. In this class and in accounting, debit means the left side of a T account. Credit means the right side of a T account. The debit means the left side of the T account. Credit means the right side of the T account. I'm going to say that a lot today. Okay? So do not or try to resist. Do not think of the way that others use these terms. Like some of you said, okay, debit, credit, I've heard those terms when I go to the bank. Well, you may have. Does anybody here work at a bank? If you work at a bank, disassociate yourself from that fact for now. Do not think of the way that banks use these terms and try to learn your debit and credit stuff in this class that way. Debit means the left side, credit means the right side. Are you with me? So don't think of what your teller may have told you in the past. Do not think of your plastic debit cards and your plastic credit cards. That will just mess you up. Don't be thinking, okay, now I have a debit card, I have a credit card, maybe I can use that. No. Don't think of your debit cards, your plastic cards. Don't do that, okay? Debit means the left side. Credit means the right side of a T account. Are you with me? Don't think of debit as debt. Well, maybe it's the same thing as debt. It kind of sounds like, no. Or maybe credit is like when the world, or when a bank gives you a line of credit. No, no, no. Debit means the left side, credit means the right side. Are you with me? Don't mistakenly think of debits as good things and credits as bad things. No. Debit means the left side, credit means the right side. Now, this next slide is very, very important. Debit means the left side, credit means the right side. Debit means left, credit means right. Are you with me? Okay. Now, I don't know why they use the terms debit and credit. It would have made my life easier as a teacher if thousands of years ago they would not have used the terms debit and credit, but they would have rather used the terms lefty and righty. Okay? But debit means left, credit means right. Now, let's look back at this. Looking at what we have done, you might understandably but mistakenly think that debit means increase, credit means decrease. I can understand why you would see that, but it is not true. Debit does not mean increase, credit does not mean decrease. Debit means left, credit means right. And the reason is, well, let's take a look. First of all, if you have a T account, the left side is always called the debit side. The right side is always called the credit side. And we abbreviate that with these terms, DR and CR. So don't ask me why those are the abbreviations. I don't know, because I know there's no R in debit. Okay? Now, for cash, yes, increases were kept track of on the debit side, and decreases were kept track of on the right side or the credit side. But it's not always the case. For example, let's look at a T account for a different account. Notes payable. Now, what's the left side of the T account for notes payable called? Debit. What's the right side called? Credit. Okay? For notes payable, increases are kept track of on the right side or the credit side, and decreases are kept track of on the debit or left side. You with me? I know it's kind of weird. Just like when Dad took off the training wheels. You might be crying and go, Dad, please put the training wheels back on. Okay? So, debit and credit do not mean increase and decrease respectively, because sometimes, as with cash, increases are on the debit side. And some accounts, like notes payable, increases are on the credit side. Now, regardless of the account, opposite sides of the line, opposite effects. Thus, if this is an increase, this is a decrease. If this is an increase, this is a decrease. Okay? Hold your question just a second. So let's look at the chapter 1 way of doing things. Let's say that you got a loan from a bank for $5,000. Well, your cash would go up by $5,000 and your notes payable would go up by $5,000, correct? Well, how would you report that or record that using T accounts? Well, increases for cash are kept track of on the left side or the debit side. So you would write 5,000 right there. Increases for notes payable, as I've told you, are kept track of on the credit side. So you would write that right there. Are you with me? I know you have some questions. I'm going to hold you off till the end, okay? Now, let's say it's an interest-free loan and you pay off $300 of it. Well, in the chapter 1 way, cash would go down by $300. Notes payable would go down by $300. How would you show that on T accounts? Well, I told you that for cash, Decreases are on the credit side, right? And I told you for notes payable, decreases are on the left or the debit side. Are you with me? Now, I never want to see pluses or minuses in T accounts. Never, never, never. Never want to see dollar signs either. Okay? Another thing, when I wrote that 5,000 there, that was called debiting the account. So if I say I'm going to debit cash for 5,000, that means I'm going to write 5,000 on the debit side. If I say I'm going to credit notes payable for 5,000, that means I'm going to write 5,000 on the credit side or the right side. Does that make sense? Okay. Now, all accounts are debited and credited. You just have to know whether those are increases or decreases. Okay? Take a look at the next slide. Cash is what we call a debit balance account. That means that's how you increase it. You debit it, and thus you decrease it when you credit it. Notes payable is what we call a credit balance account. That means you increase it with a credit and decrease it with a debit. Does that make sense? All accounts are both debited and credited, though. Just like all accounts are increased or decreased at times. Okay? Now, I told you that cash was a debit balance account. We kept track of increases on the debit side. I told you that notes payable is a credit balance account. Credits are kept track of on the credit side. And remember, there's no pluses or minuses. The question you should have in your brain now is what? Does anybody know the question that should be in their brain? How do you know which accounts are debit balance accounts? Thus, they increase with a debit, decrease with a credit, like cash. And how do you know which accounts are credit balance accounts? Like notes payable. They increase with a credit and they decrease with a debit. Okay? Well, I have a chart for you. Look to see if this is in your Chapter 2 notes. Is this chart in your notes? Okay. Is it the back page of your Chapter 2? Yep, you have it. Okay. Now, let me tell you how not to learn these. I have listed here, and you folks at home have this as well with your handouts. I have listed here the accounts, and if they are a debit balance account, thus they increase with a debit, decrease with a credit. Or if they are credit balance accounts, thus they increase with a credit, decrease with a debit. And you can see cash is properly listed as a debit balance account. Notes payable is properly listed as a credit balance account. Here's how you do not want to learn these. Go, okay, well, cash I know is a debit balance account. Okay. Let's look at the next one. Accounts receivable. I think that's a debit balance account too. Yep, I'm right. Inventory. Okay, that's a debit. No, they're all listed together. That's not going to do you any good. Even in 2014, what is the best way to learn your account balances? Which accounts are debit balance accounts? Which accounts are credit balance accounts? Flashcards. Okay? I don't care if there's a computer app or an iPhone app. Flashcards are the way to go. Let me show you an example of a flashcard. This is an example of a flashcard for cash. I'll show you what's on the other side in a second. But you'll make one of these for each account. Like here's 4 different assets. Cash, equipment, supplies, land. That's on the front of the flashcard. On the back of the flashcard, this is for cash, is a debit balance account. Thus, a debit increases it, and a credit decreases it. And then I even went further and said, and cash is an asset, and what financial statement does cash go on? The balance sheet. So you make a flashcard for each one of those accounts. Okay? We might go a couple minutes over. Okay? You make a flashcard for each one. You must learn this. You must learn this. And if you refuse to learn it for some whatever reason, you should just drop the class. I don't mean to be dramatic, but you can't do accounting unless you learn which accounts are debit balance accounts, thus they increase with a debit, decrease with a credit, and which accounts are credit balance accounts. They increase with a credit, decrease with a debit.